registered businesses with an annual revenue of under 450 million or US dollar equivalent, which gives you the opportunity to maximize the value of every dollar earned. The benefits? No nuisance fees. Never have to deal with monthly service fees, account dormancy fees, and minimum monthly balance requirements. Easy payments. Enjoy free bill payment and free inter and intra-bank automated clearinghouse ACH transfers within Jamaica. Interest accumulation. Earn interest and grow your company's money over time. Interest is calculated daily and paid monthly. One free manager's check per month. Check leaves available upon request, or ask about our special pay-as-you-go check feature. Speak to a JMMB bank representative today to see how the JMMB Smart Business Account, along with our Small Business Loan Solutions and SME Resource Center, can support you in growing your business. Follow us on Facebook, Twitter, Instagram, and LinkedIn at JMMB Group, or visit our website, jm.jmmb.com. JMMB SME Resource Center, a partnership that goes above and beyond. Because you need more than just a bank, we are committed to offering support and guidance to small and medium-sized businesses, or SMEs, every step of the way. The JMMB SME Resource Center ensures that you are prepared to access JMMB's banking, investment, and insurance brokerage services, along with our business planning expertise. The center provides customized advice to take your business to the next level. The JMMB SME Resource Center will help you to identify financial opportunities, develop a professional business plan, structure financial statements, and solve business challenges with the help of our network of business partners. Are you ready to grow your SME with JMMB? Speak to one of our JMMB SME representatives to find out how we can partner with you. Follow us on LinkedIn, Facebook, Twitter, and Instagram at JMMB Group, or visit our website at jm.jmmb.com.
Good evening, everyone. Welcome to JMMB's SME Resource Center workshop. I am seeing quite a few of our resident workshop attendees. Thank you so much for always choosing to spend your Tuesday afternoons with us. And for those of you, this is your first workshop, welcome. And I guarantee you that you're going to be attending all of our future workshops. We hope to hear from you how you're feeling about tonight's session, the importance of understanding and updating your financial statements. So please let us know in the chat window how you are feeling about tonight's session, what you're looking forward to. I am Tanis Booth, and I'm one of JMMB's SME Resource Center officers. I work predominantly with our clients in the western end of Jamaica. For the rest of the night, I will be your host, and myself and a few of my team members, including our team lead, will ensure that you have an enjoyable and an informative session. We have a tradition here at JMMB where we start all our workshops with a word of prayer as well as a section. We like to share a section of our vision of love with our clients. And our vision of love document, it's an internal document that was created by us team members, and it speaks about the company's core values and how we want our clients to feel when they interact with us, how we want as team members to be treated. So Vincent, who is our Senior SME Resource Center Officer, is going to lead us into prayer. And then Natalia, who is our Strategy Officer, and she works out of our Trinidad location. She will be sharing our specially selected section of the Vision of Love with you tonight. You can go ahead, guys.
Okay, thank you, Tanis, and good evening, everyone. Let us pray. Heavenly Father, we give you thanks and praise for taking us safely through today. Lord, you are indeed our strength and protector. You lift us up when we are weak. In our darkest moments, you are there to strengthen and help us and to uphold us with your righteous hand. You fill our hearts with love, joy, and happiness. Lord, as we meet virtually tonight, we give you all the glory and praise for all the things that are wonderful, all the things that you have caused to happen to us in our lives. Lord, we pray that tonight's presentation will be beneficial to all and that we will have a greater appreciation and understanding of the importance of having updated financial statements. This we pray in the mighty name of Jesus Christ, our Lord. Amen.
Amen. All right. And for the reading from our Vision of Love, it states JMMB is committed to life in all its abundance. Accordingly, team players recognize the links between the organization and the wider society and the interrelatedness of all life. In keeping with this, JMMB is committed to being actively concerned with the conservation, preservation, and sustenance of the natural environment in order to ensure sustainable development. Back to you, Denise. Denise, you're muted.
I'm so sorry. Thank you so much, Natalia. So I do notice that my chat window is empty. So I hope that as we go through tonight's session, it's going to become very active. I want you to feel comfortable asking any questions that you have, sharing any feedback. Tonight's session, we have workshops here at JMMB Resource Center. We don't have, it's not a webinar, so feel free to participate actively. As I mentioned earlier, we will be discussing the importance of understanding and updating your financial statements. And one of the ways that we also work with our clients, apart from the workshop that we put on a monthly basis, is through our SME Resource Center solution. But what is the SME Resource Center? For us, we want to be your partner. For us, it's about working with our clients and helping them to transition through the different stages of their business life cycle. So we want you to grow with us from being an SME into being a corporate. And we do that by providing you with solutions that exist here at JMMB, so in-house solutions such as our fabulous business accounts, also our loan or financing solutions. But we also have partners that we work with. And these partners are professional persons who have been specially vetted and selected by us because of the high quality service that they offer. And we have partners in areas such as HR, marketing, accounting, and a few others. But we also support our clients by providing them with business tools and templates. So things like business plan, accounting, document templates, you can get that from JMMB SME Resource Center. But how do we know what it is that you need as a business owner to grow your business? And we do this by ensuring that we offer you a free needs discovery. And this is an in-depth conversation that is designed to help us to understand you and your business and your goals and identify which of our solutions will be able to assist you. So if you're not an existing JMMB SME client and you'd love to join the family, feel free to send us an email. We will provide you with our email address and we'll definitely help you to join the family. If you are an existing SME client and you believe that there's a solution that you are not currently accessing, or if you have a problem that you would love us to help you to solve, please reach out to us. We're also big on ensuring that our clients are able to grow through what we call our networking opportunities. So we offer things like our SME directory, where it consists of all our business plans. You have the opportunity to share your business service with a wide array of our business plans. So that is what we do here at JMMB SME Resource Center. So tonight, as I said before, we have with us our team lead, Mrs. Shani Duncan-Falconer, and she's going to be taking us through a very informative session. Shani has an entrepreneur master's degree. She also is certified in events management, solar business, and technology sales. And she also lectures in entrepreneur. So you have someone who is very rounded in the entrepreneurship lifestyle. She has over 16 years of working with SMEs, not just here in Jamaica, but also in Kenya. And not just in export, we can share in Jamaica, but you can tap into access can in Jamaica. So that is it about us and the second center. Join is going to give us two important of updating our financial. And the financial statement is
I'm sorry, I think your audio is out.
are you hearing me any better now?
Yes.
Okay. Well, I was well, I'm not sure where I dropped off. So I was handing you off understanding our financial statements, and those are two words that you will hear continuously throughout your business life. And so she's going to ensure that you are in a position, but when these words come up, you are able to feel comfortable in having the conversation. So Shani, the session is over to you.
Hi, good night, everyone. All right, so as Denise said, what I'm going to do is to really focus in on the importance of understanding your financial statements, understanding them and why it's important to update them. So this is not a presentation in terms of this is how you do a balance sheet, this is how you do a profit and loss or cash flow. It is more about understanding the elements of it so that you know why it's important, so that you do it, so you don't just leave it there. You do it one time and you're like, well, I did it one time and that's enough. No, it's not enough. So I really want to underscore that, and that's what we're going to be honing in on in this presentation. All right. I don't want here. All right. You guys are seeing, right? I think if I put it in the other view, it comes up differently. All right. All right. So there is really no hard and fast rule about what you should look at and what stage your needs are going to vary, right? So within your business, you're going to have different stages within your business life cycle. So what you have to understand is that there's no straightforward method or formula to ensure financial success and growth of your business. But what is important is that it's knowing that it's an ongoing process that you have to work at. And in working on that, you have to know that it is your commitment and rigor around understanding those business financials and the process of what is reviewed and when. So I want you to know that you always have to consistently monitor it. So I'm not saying that for your finances, you are the ones that have to do it. No. If you're not strong at finance, that's when you're going to hire your accountant, you're going to make sure you have your financial advisor, and those experts will push you in the right direction and be able to give you all of your statements. But with them giving it to you, it is not something that you take and you're like, okay, well, I have it. No, it is something that you need to understand, okay? So when I was trying to find out, why is it that, I feel like I'm jumping ahead of my presentation, but I was talking to someone and I was like, why is it really that person should understand their financial statements and have them updated? And the reason he said is because, and he's an accountant, he's like, your financial statements are the resume to your business, right? So just like you have your resume, you update it when you want to go and get a new position. And once you do something new, you add it to your resume. So that is what your financial statements are. They tell you everything about your business. And you want to make sure that if you take those financial statements to a bank, an investor, to your team to show them where you are in your business, you want to make sure that they're properly done, that you understand them, and that you could explain them, right? So always just keep that in your head. Your financial statements are like the resume for your business, okay? So what are financial statements? Just clear, simple. They are a key tool to running your business, right? They're a snapshot of the company's finances, and they give you crucial information on the business's performance. They're used by bankers, investors, team members, board members of your board to assess how healthy your company is and to make those decisions that will affect your company. It also shows the sustainability of your business so that you can make educated financial decisions. Sometimes as a business owner, we make decisions based on, you know what, that might be a good idea or that look good, but then have we really thought it out? Have we put pen to paper and say, all right, well, if I buy X amount, this is what it's going to cost me to purchase X amount, and then this is how much I want to make profit on buying X amount. So don't just make decisions in terms of, yeah, you know, it's a hunch. It sounds good. There's a hunch, and then there's strategy. So fine, you start with your hunch, but then you say, okay, let me put pen to paper so that this is a calculated decision. And that is what business is about. It's about taking calculated risk, not just random risk. You're not gambling. You are taking a calculated risk. And in doing that, you have to have your financials and understand your financials, right? So in line with that, your financials supposed to be able to provoke discussion so that it would show that you're on track. So with your numbers, when you really start understanding your numbers and understanding, okay, where you are now and thinking about where you want to grow, and when you're able to see that on paper and understand it and manipulate numbers and work out the numbers, it really is exciting because you see the potential that your business has. So this is for you. This is not for your banker. This is not, oh gosh, I need to do an audit. This my bank needs to do update for my loan. No, don't think about it like that. Think about it as being excited as to where your business is going to grow within the next 2 years, 5 years. And the only way you can know that is if you actually put your financials together. With your financials, you're going to know that you could prepare them for different time frames. So it may cover a year, or you could do it monthly, quarterly, semi-annually. So it just depends on your needs and what is going on at that point in your business that you're going to say, you know what, I need to make a decision. So I'm going to update my financials to see where I am and if this decision is good for me. All right. So in terms of the benefits of understanding financial statements, a financial statement has to come with explanations. So when you get your financial statements back from your accountant, if it's your accountant doing it, good financial statements are going to come with explanations. And if your accountant not giving you those explanations, you're going to go back to your accountant and you're going to be like, where are my explanations, right? So just you understanding what it's supposed to have, you will know what you're supposed to see when you get it back, okay? So what it does, it is necessary for attracting and assessing worthwhile partnerships. It's important for attracting equity and other financing locally and internationally. It opens doors to business opportunities and customers locally and abroad. So when you're able to say, all right, this is where I am now, this is where I want to be. You have to take a look at your financials, and then you could see, okay, you know what, I could expand to other markets. This is what it's going to cost to expand to other markets. So understanding that will open up doors for new customers, new partners, a new level of understanding of your business. It also attracts quality staff, because sometimes you think that, you know, I have to keep my financials tight. I can't show anybody my financials. But when your business is booming, as I said, it's your resume. So quality staff is going to want to know, you know what, is this company doing well? Is this a company that I should stick with? And being able to show that off is actually a great thing, because you're going to be able to go out there and be like, the same way they're in staff, you are interviewing staff. I think a lot of members now, team members and staff, have been saying, you know what, is this a good company to work with? So I think it is very good to open it up and to allow persons to know what they're getting into, right? Also in terms of facilities and getting better terms for your financing. So this is now on the bank side, right? If you understand your finances and you realize that, you know what, my sales have been growing, but I have been getting a loan and it is at this rate and this percentage. What it allows you to do is to go back to your banker and have proper open conversations to show them how well you are doing, and that you can have discussions about your loan facilities, right? So you don't want to say, you know what, I need a loan, and then you send the banker your financials, but you don't know what's on your financials, but you're sending it to your banker because you're thinking that, okay, well, the accountant did it. But then your accountant is not the one who is explaining and who knows intimately your business. You know it, you have the passion for your business. So the same way that you have that passion for your business, you need to have that passion in terms of understanding the numbers, so that you can now explain it in detail to persons who you want to invest in your company or to be able to loan you funding. All right. So in terms of, we're going to just go through it, all the key points. So in terms of assessing financial health, right? That is one of the first points. So as I said already, by analyzing the company's financial statements, you can evaluate the company's profitability, right? From that, you're going to look at your income statement, which is your profit and loss, so that you're going to understand, is my company making a profit? Is this the profit that I thought my company would make? So you're going to have to understand what that income statement is telling you. Then your cash inflows and your cash outflows, that's an extremely, extremely important part of your financial statement. You need to understand where the cash is going, when it's coming in, when it's coming out. And with that, we'll also get to accounts receivables, which I'll talk to later about, which are aging receivables, because that is a report that you're going to need to know, because you're going to need to know, do I have money on the road? Do I have money that needs to come in? If this money came in, I'll have more cash to be able to do things that I need to do. So you have your accounts receivables, and then you have your payables. Are you paying your suppliers? Can you get better terms to pay your suppliers? Right? The same way your clients are asking you for 60, 90 days to pay you, it's the same way you need to be asking your suppliers for those long terms. So for those 60, 90 days. So that's why you need to understand those things in your financials, so that you could delay payments, but on the other end, bring in the money from your client. So we'll try to go into that based on the timing that we have, when I could get into a little more detail on the different financials. So it also helps you to make informed decisions. So you're going to say, I need equipment. You have the money for equipment. You have to know if you're going to be able to buy that equipment. When you see depreciation on your statement, you're going to have to know, oh yes, my equipment is depreciating. And then you can ask informed decisions. You could be like, so ask the accountant, what rate did you use for my depreciation? Making sure that it's the right rate because you know your equipment, you know, so you're going to have these better in-depth conversations with your accountant and the persons who are doing your financials. All right. And then, as I said before, in terms of expanding into new markets, it helps you to make all those decisions so much easier. A big part of it, and I said it before, communicating with your stakeholders, your investors, your lenders, your suppliers. These are things that you can do and do it from an educated point of view when you know it. So the same way you're coordinating with your stakeholders, it's the same way that you're coordinating with your accountants and your financial advisors to make sure that your goals are being accomplished for your business. Compliance, compliance, compliance. For your tax returns, we all know that you need to be compliant on your tax returns as a business owner, right? So you don't want to be hustling at the end to send your accountant 2 pieces of information, 1 piece of information, like all scattered. You want to know, you want to have it all together. And guess what? When you have it all together and in a proper format, they could charge you less, you know, because when it takes time for them to put random pieces of information together, that is more time that they're spending on you, and they are charging you for the amount of time that they spend on you. So if you, on the other hand, have everything together, you're understanding what you have together, you send everything in a proper format to them, then they're able to do it quickly for you, all right? So you have to think about it, your compliancy, your being tax compliant. And also, you have a loan. If you have a loan from the bank, we need your annual reviews. We need to know what is happening. We need you to be compliant and send us your financials. It is not something that we're asking. It may be something that would help you to be able to say, you know what, you have excess cash, or us looking at a debt to equity ratio and saying, you know what, if you did want to expand, we would be able to help you with an additional loan. So it is not a bad thing. And even if you're like, okay, you know what, my business isn't doing as well as I expected it to do, it's not that you have to hide from us. We understand that's how business is. So what you say is, this is where I am now. And then we can help. We may be able to say, you know what, based on what it's looking like now, this is how we're going to have to restructure. So it's not something that you hide from us. It is annually, we want to help you. Look at it in that way, as opposed to, oh my gosh, I need to hide these from my banker. I can't bother to send them into Shani. I can't bother to send them into JMMB because they're going to look at this and take away my loan. No, please, please, it's important, okay? It's important to be compliant. So in terms of why you should update it. So before I was talking about the importance of understanding it. Now I'm going to tell you why update it. So you don't want your financials that you did once when you start off your business and you're like, oh yes, you know, I have this business plan and I have my financial statements with it, but you never ever update it. Like, it's like, as I said before, you're never going to update your resume. You've never done anything new in your life. No, like when you left college, versus when you've been working for 16 years. I'm sure you're not going to send any employer a resume that tells about when you were in college and high school. No. So that same way, please continue to update your financials, because it is telling you a lot about what you have accomplished in your business. Or maybe it's not what you accomplished, but it may be slightly different from what you wanted to accomplish, but then you're going to be able to do financials and have a growth component to it, to show, okay, you know what, if I make these changes, this is what's going to happen in 1 year, 2 years, 5 years. So it's very important. So continue to update your financials. As I said, monthly, quarterly, annually, especially, it has to be annually. If you don't do it monthly, quarterly, fine. Please just do it yearly and understand why you're doing it. All right. And as I said before, it allows the bank to review the terms and conditions of your loan to ensure that, you know, that you are adhering to them, and then also to ensure that we're giving you the best of what you need to get. And it will show you now, is your business doing good or is it bad? What do I need to do to make sure that my business does better, right? So how can you correct your weaknesses? And you are able to do that through numbers. That's, your numbers are it's one of the only things that's going to give you real solid information about your business. You can write the best plans, right? You can have the best worded documents, but then at the end of the day, what are the numbers really saying? And that is what is going to be important and carry your business through. All right. So failure to comply could starve your business of the well-needed cash that a bank could be looking at to be able to refinance some terms for you. Or even if it's not a bank, it could be that an investor may be interested in your business, but you don't want to be scrambling at the end of the day. Oh, this person came to talk to me, he's interested, but I don't have anything to show him. That's a red flag for an investor, that you don't keep up with knowing how your business is going and having up-to-date information. So always have that on board. All right. And it can help in terms of the evaluation, right? So are things changing due to internal or external factors that may affect repayments, such as management, change in business model, government? That's all talking about when we look at different things like the industry analysis, you know? So all of those come into play, and we have to know about how that is being evaluated. All right. And then, as I said, you can take on additional borrowing. You may not even realize that you can, but those financials are going to be able to tell you. All right. So when you do understand what your financials are saying, you can now implement strategies into your business. So a big thing is that you'll be able to manage your cash flow. One of the most important factors in your business is liquidity, and you get that from your cash flow. All right. You're able to see how liquid your business is. So by managing your cash inflows and your outflows, you need to know if you are spending too much, if your outflows are more than your inflows. Sometimes business owners will underprice, definitely underprice the value of their services or underprice their goods. And then at the end of the day, they're like, but I didn't make any money. So you have to understand what your liquidity looks like, what your margins look like, so that you know that you're negotiating properly with your suppliers. So as I said before, you negotiate with your suppliers the best deals, discounted deals on goods that you may have for your business. And then you're also going to say, you know what, but I want these longer payment terms so that it does not affect your cash flow in a negative way. All right. So you're managing your cash flow, you're looking at it. When you go into your income statement, right? You can say, you know what? You can review all those expenses that you have, right? So in terms of expenses, maybe salaries, rent and overhead, you can say, you know what? This not making sense. My overhead are too high, right? So knowing that, okay, you know what? I need to find out where my accountant gave me my information, but where do I look to find where my overhead costs are? And you have to know that you're going to look in your income statement and you're going to look under your expenses and you're going to see all the items that you sent into your accountant, how much you paid for GPS, how much you paid for rent, how much you paid for water, and all of those are going to go into your expenses. And then you have to make strategic decisions about that when you're like, oh my gosh, I didn't realize it was so much. You have to say, okay, well, maybe if I were able to, maybe I don't need this space, maybe I can cut back. But you're not going to know that if you don't do your own analysis, right? And then sometimes you can say, all right, so I have analysis, I have what I've done in the past, but I know that I want to grow 5%. You know that the inflation rate, for instance, for Jamaica, between 6%. You need to grow with that inflation rate. So you're going to go into your financials and you're going to forecast and say, I need to beat inflation. I need to make 10% better than I did the year before and keep doing that year over year. So you're going to go into the financials and you're going to do forecasts and you can set it up. And I'm going to show you, hopefully we get enough time, where you set it up and you put in your growth numbers and you say, you know what, 10%. And once you've set everything up correctly, all your numbers change and you see how that affects all of your financial statements. So it's these things that you have to go in, understand and play with so that you know how your business will perform in the future. All right. Do we have any questions?
Yes, we have one question.
Okay.
What is the proper format that the information should be sent to your accountant? And if you have any example that you can share.
All right. So what I'm not saying that you have to send in a proper set out income statement, balance sheet, cash flow. But there is a lot of accounting software that once you put in that information, even QuickBooks, once you put in your information and everything about your business, it is supposed to be able to spit that out for you and to show you that information. So you buy stock, you put it into that accounting software, and then it places it in the right places for you, you know. So it's not to say that you're building these balance sheets and you're building these financial statements by yourself. The best thing to do is to invest in software that will be able to, that whatever you put in, puts it in the right spot for you. All right. And then at the end of the day, you tell your accountant, you give your accountant a separate password or a separate access to those accounts. And then they would be able to now go in and be like, all right, well, you know what? She's been updating this very well. You know, I can put this together for her. And then I could just put the notes to say that these financials have been audited, which is what we like to see at the bank. but it makes life much easier. And you can now go into the software and look at it and be like, oh, you could get an understanding of your business. So I would suggest that you put it into a software from the beginning, all right? Or if not, Excel. And I'll be able to show you guys, hopefully if we have enough time, what that layout looks like. All right. Any other questions?
Do you have any other accounting software that you'd like to share, Shani? That was another question. Apart from QuickBooks, any others that you'd recommend?
Which one? Waves is one. I remember I had done a presentation and it had all of the different ones, but I know
Zoho is another good one.
Right, Zoho. So I think those are the top three: Zoho, QuickBooks, and Waves. Yes. So in terms of being able to just easy, simple, put in your information, and then it being able to put together those statements for you, especially your cash flow. Your cash flow is very important, and it will be able to do that for you. Any other ones, Denise, that I know those are the two.
Sarika, who is one of our partners, is saying Sage. So
Okay.
that you can also use.
Right. So yes, definitely, Sarika, you need to take her advice, because that is an accountant who you can use, and she would be able to put everything together for you and make sure they're audited, you know. So yes, definitely. Go ahead.
Yes, you can continue.
All right. Okay. So other strategies that can be implemented is your different financing opportunities. You know, how can I raise capital? How can I improve my liquidity? Oftentimes, maybe you may need to sell assets. So you may realize, you know, selling off some non-core assets can be a good way to generate cash and improve liquidity. You can have assets that you realize are sitting down there and you don't use them, you don't need them, so sell them. So whether it's assets or whether it's underutilized equipment or property, you know, you can divest from those non-core business units. All right. So just knowing where your assets are, balance sheet, understanding where they are, you can get cash from selling those that you're not using. And then you could also improve your inventory management, because excess inventory ties up valuable cash, right? So you could improve your liquidity by optimizing your inventory management process, all right? So knowing that, okay, this is the optimal amount of inventory I need to keep, and having just-in-time inventory management systems helps you to be as profitable as possible in your business, right? Because if you're sitting down on things that are not selling, that's not being profitable, okay? So improving liquidity is a combination of effective cash flow from your cash flow statements. You could see that expense reduction. From your income statements, you could see that sales growth, asset management from your balance sheet, so that when you look at all of those together, because they all flow into each other, right? So now you can see how healthy your business is and how it can be successful within the long term. All right. So what I'm going to do is now get into a little bit in terms of the statement and what these statements tell you and why it's so important. So this balance sheet, everybody has heard all of these statements already. Balance sheet, profit and loss, statement of cash flow, right? Those are the three main statements that you need to know and that you need to understand, okay? So starting with the balance sheet is a snapshot, right? So it's a snapshot that is going to show you your assets equal to your liabilities plus your equity, right? So it is going to show you your company's accounts receivables, the debt that you have, long-term investments, your retained earnings, and then if you have shares, the number of shares outstanding, right? Then we have the P&L. The P&L is also, some persons say, the income statement, and that is going to show you your revenue and your expenses, and then your revenue less your expenses. It's going to tell you, are you making a net income or a net loss over a certain period, right? So you're going to be able to see on that your total sales, your cost of revenue, the taxes that you've paid, your interest expense, and your operating profit. Then we have your statement of cash flow. Your statement of cash flow is monthly. This is one that you always need to know because everybody wants to know what their cash looks like, right? So your cash flow, whether it's monthly, quarterly, annually, it's going to show your liquid assets over a period of time. And this is one that you really have to understand and to know, because you're going to be able to see where your good seasons are, where your bad seasons are, where you may need a little more flexibility from your suppliers, where you may need to say, okay, you know what, I need those funds that are out on the road, those customers that owe me money, I need it to come in during my periods where I'm a bit slow. So I think this one, understanding it and always looking at this one monthly is very, very important, okay? Because we want positive cash flow, but when we see negative cash flow, it can be an indicator of financial difficulty. And you want to know that. You don't want to know that at the end of the year. You want to know that during the time, during the year, so that you can do things to mitigate when you have those shortfalls, all right? Cash issues are the, I mean, I don't have to tell any of you guys that that's the sign of trouble, right? When you have cash issues. So I really think that this is the one that you have to pay close attention to, even if you're not using the QuickBooks or any of those other programs. You make sure that you have this one in Excel, that you know what your inflows and your outflows are, right? All right, so getting into the balance sheet, right? The balance sheet is going to tell you your business financial position at a particular point in time, right? It shows what the business owns, what it owes, and what equity is left over, how much you have left, right? So here are some key insights that I want you to know when you are looking at your balance sheet, all right? So liquidity, you're going to look at your balance sheet and understand how much cash and other assets you have that can be quickly converted into cash if needed, all right? So, well, I wonder if we do have enough time. All right, so let me see if I can move over to an example. All right, okay, so you all are seeing this, right? So your balance sheet, where I was saying that you want to see how much cash you have and what can be quickly converted into cash. So that is going to be your cash, your accounts receivable, and your inventory, right? So you're always going to want to know what those are. How can I get, am I liquid? Do I have enough money to be able to support my business, all right? Then you're going to look at your solvency and determine your ability to pay your debts as they come due, right? And you can do this by calculating your debt to equity ratio, all right? So you want to know what your debt is versus what your equity is. All right, so total debt over total equity. All right. You know what, let me go back to the presentation because I actually show you how to do it there, and then we can come back to a real life example if we have the time. All right, hold on. I wish I could share both at the same time. All right, okay, so let me show you your debt to equity, all right? So this one is going to measure the proportion of debt and equity used to finance a company's assets, right? So in simple terms, it tells you how much of the company's assets are financed through debt, which is loans, versus how much is financed through equity. So a high debt to equity ratio is going to indicate that the company has a lot of debt, right? A lot of loans, right? And it's so when you come to the bank, we're going to see, okay, do you have a lot of loans outstanding, or do you have more equity in your business? And that is going to tell us your financial leverage. So let's look at this. If your total debt in terms of loans that you have is 100,000 and your total equity is 50, that would be a ratio of 2 to 1. What does this mean? That the company has twice as much debt as equity. Is that good or is that bad? That is going to indicate a higher risk of financial distress because you have so many loans out there as opposed to the amount of equity you have, right? So that is an important ratio that you would need to know. So when you're looking at some key ratios, I'm going to tell you which key ratios to look at so that you understand your financials and you could say, well, you know what, if I go to a bank with this high debt to equity ratio, it's going to be a bit negative. Or if I go to an investor, you know, they're going to be able to see how much money you have out on the road versus how much money you have within your company. All right, it's used by investors, creditors, analysts to evaluate the financial health and risk profile. All right. The liquidity ratio is another very important ratio, and that is one that is very easy to work out, right? So going back to a balance sheet, the balance sheet that we saw, you can work it out by looking at your current assets versus your current liability. And this is important because it's going to measure your company's ability to pay off its short-term debt using its current assets. So using what I showed you before, your cash, using your accounts receivables, using your inventory, all right? It's going to be able to show you if you needed money, how quickly you'll be able to get that money, all right? So looking at an example, your current assets are 750. So you're going to see in your balance sheet, your current assets are the first set of assets that are going to be there. So that, for example, is 750,000. And then your current liabilities, you're going to see, okay, that's 300,000. And you're going to be able to calculate that. And your current ratio in that case is going to be 2.5, right? So simple terms, it means that the company has $2.50 of current assets for every $1 of current liability. So that means that the company has sufficient liquidity to meet its short-term obligations. So if you needed to know how liquid your company is, like if an investor were to ask you, how liquid is your company? Go into that balance sheet and do that quick calculation, and then you're going to be able to be like, well, you know what, I have a 2.5, and it's good, and they're going to be like, well, yeah, you know, you're pretty liquid. So it's not going to tell you the full circle of everything of your entire financial health, but it's going to tell you how you're using your cash. All right. Another one in your balance sheet is looking at your inventory and your inventory turnover. Okay. So you want a high inventory turnover. You want to make sure that you are quickly getting those goods out, that inventory is going out, churning every day, every week, and you're not holding on to that inventory. All right. So you're going to look at your cost of goods sold, which is going to be on your balance sheet. It's going to be assets minus cost of goods sold. And you're going to look at that versus your average inventory, all right? So that you can see how much you're selling over a certain period, all right? A low inventory ratio is going to, on the other hand, indicate poor inventory management, all right? For example, a company has a cost of goods sold for $1 million, and its average inventory during the year is 200,000. Its inventory ratio would be 5. So this means that the company sold and replaced its inventory 5 times during the year. You have to know in your industry now, is that good or is that bad, right? So if you're a grocery and you're only replacing your inventory 5 times during the year, that's not good. But if you are selling specialized furniture and that may be good, that it's turning over, and especially if your furniture a piece sells for $1 million, $2 million, you know, that's probably a good sign. And then you break it down into the different items that you're selling. So it's not that you have to take all the inventory, lump all the inventory together. No, you can, if you are doing specialized equipment, specialized furniture, you break it out, and then you could see, you know what, this is good, this is turning over. Or you can plan and say, you know what, this is only turning over 5 times during the year. What strategies now can I use to ramp that up? Do I need to target new customers? Where do I need to go? So it helps you think about different things you need to do based on how often you're turning over your inventory, right? All right. Aging receivables. So this is all still looking at your balance sheet. I'm going to get back to your profit and loss and your cash flow, but just looking at this is how key your balance sheet is, right? So what your balance sheet tells you so much. So what you can do is an aging receivables report. And especially too, this is also sometimes something that the bank may ask for if you have a loan with the bank, right? So it's going to show you and help to keep track of the amount of money that the customers owe to your business. So you may have sold an item and they didn't give you the cash right away. So this is now going to go into your receivables, because usually if they don't give you cash right away, you should have terms with them, 30 days, 60 days, 90 days. And then based on that, there's an interest that these clients have to pay when they don't give you your money on time, right? Maybe you don't have it like that, but at least you should know what your aging receivables are. So it's going to tell you the amount, the duration of these unpaid invoices, and then the potential risk of unpaid debt. So it's typically divided into several columns, as I said before, 30, 60, 90 days. You don't want it to get to 90 days, okay? So you want to make sure by having this report, you're calling those customers who owe you money. You're like, pay me. But if you don't have these reports and you're just leaving your money out there, it's not helping your business. So make sure that you do these reports monthly and you're able to see, all right, in my receivables, I have this customer didn't pay me in 30 days, but maybe I'm giving them 60 days. And it depends on your business. So not every business having your receivables at 30 days is good, but some businesses it is okay. A lot of times when you deal with government contracts and you're doing a service for government, they ain't gonna pay you on time. It's going to be receivables, right? So you just have to know your client, know your business, and know what is good for your industry. All right, because this is a very, very important tool in being able to manage your cash flow, predicting your revenue, assessing your credit risk, and then it will be able to help you identify patterns so that you know you can make new decisions about what you want your credit policies to be. Because you could say, you know what, this credit policy on 90 days is not working for me. And I need to give clients 30 days and that's it, because you're making my liquidity ratio fall and and my company is not liquid because I'm leaving all of this out on the road. So, and my profitability is also falling. So you can play with those numbers. You can have your numbers and then you can move them around and say, if I had this, this would happen. All right. But it's just understanding what all of those ratios mean and how to use them. All right, let me go back to the profit and loss. All right, so that was your balance sheet, and in terms of being able to understand your balance sheet, right? If after we can, I will go into the actual Excel and be able to show you the different items in it. But this is really about why, the why as to why you need to understand it, not necessarily going into it and being like, this is how you set this up. No, it's what happens behind the scenes of all of these statements. All right. So as I said before, your profit and loss, also known as the income statement, this is where you're going to see all of your profitability. Are you profitable? So it's going to show your revenues and your expenses over a period of time. When I spoke to you about the balance sheet is a snapshot. It's like a picture. This one is like a movie, right? It's over a period of time, all right? So you're going to be able to see what's happening. So by subtracting your expenses from your revenue, it's going to tell you, are you getting a loss or are you making net income? Are you making profit? And it shows your profitability and whether the company is generating enough revenue to cover its expenses and to make a profit. It is a key performance indicator that investors and analysts use to see the financial health. It compares revenue, expenses, net income, and then you can use it against industry benchmarks and competitors to evaluate your company's performance. So it's always good to know the benchmarks in your industry, to know how you are doing in your own business. So that is something that I want you to take from this and be like, you know what, if I have a wholesale, or if I'm a photographer, or it can be anything. What does the industry do? Am I doing well in comparison to my industry? And where do I need to be? And what can I do so that I am a forerunner? I'm actually the top runner in the industry. You can only do that by comparing yourself to your industry, right? Your profit and loss is there to make decision making And I said it already in terms of your tax. It's going to show you in terms of your tax and your regulatory compliance, right? So it provides the basis for calculating income taxes and meeting financial reporting requirements. So what I want you to take from this presentation is that, not that you have to know everything in your balance sheet and your profits and loss and your cash flow, but you need to know how to talk to your accountant, and you need to know what the right questions to ask them. So when you ask the accountant, okay, so you've done this for me, can you show me what my liquidity is? And then you're going to know how they came up with that. Or if you ask, what's my gross profit? You're going to know what you're asking, why you're asking it, and where they get that information from, right? So your profit and loss is going to, your income is going to show you what services you're doing. Should you be offering other services or mix of other services or goods? Is your service considered satisfactory by your clients? And that's going to be seen by, are you making an income or not? Is your time being used efficiently? Are you charging competitive prices? That's why I just said before, you need to know what your industry is doing, and you need to benchmark against the industry, because you don't want to be the one who, yes, there are different strategies in terms of pricing, but you don't want to be way below the industry and then you're not making a profit, okay? But I know that there are different ways of pricing and there are different strategies for pricing, but you still have to understand what your industry is doing. Your expenses, that is what comprises your expenses of doing business. So you want to know for that, how does it compare with prior years? Are you paying competitive prices for your goods and your services? Are you using your materials properly? Is there a scope for better management of your income tax payable, right? So all of that is you're going to be able to see that in your profit and loss. So for your profit and loss now, that is where you have to understand profitability. So some key KPIs from your profit and loss. I want you to be able to know what your gross profit margin is, all right? So this is the ratio that measures the percentage of sales revenue that remains after taking out the cost of goods sold, all right? So for instance, you have a gross profit, you're making a gross profit of 50,000. That's the first profit before your net profit. So you'll see that on your income statement. You're making a gross profit of 50,000, right? And your sales revenue is 100,000. Your gross profit margin is 50%. All right, so that is the 50 over the 100,000 times 100. So you know that's a good profit margin. You're making 50% on your as a margin, okay? And that's, depending on your industry, that's pretty good. All right, so you're going to want to know, I don't know, maybe you're in an industry where you can make 100%, but you are going to have to know that. All right, you are going to have to know what it is in your industry and if you're comparable. All right, now you're going to go to another step. So you have your gross profit, then you go to your net profit. And the net profit margin now is the percentage of sales revenue that remains after now deducting your expenses, including your taxes and your interest. So now, so your gross profit is on a higher level. Now you're getting down to, okay, my net profit. What am I making on my net profit margin? So that's your net income divided by your sales. And then you're going to be able to get that. Obviously multiplied by 100 if you want it as a percentage. So if your net income is 20,000, your revenue is 100,000, your net profit margin is now 20%. All right. So obviously you always want positive numbers. You don't want that any of these are negatives. That's just not going to work. You have to make sure that you're making positive numbers on all of these. So your return on assets now. So this one, it measures how effectively your company is using your assets to generate your profits. So for example, if your net income is 50,000 and your assets are 500,000, then that would be a 10% on your return on assets. So your net income divided by your total assets. So these are all going to give you key insights and key KPIs in terms of how your business is going compared to how it is positioned in the industry. All right. Now your cash flow. Your cash flow, I kept saying that the other ones, your balance sheet, your income statement, those could be ones that you don't, if you had to know where your focus is going to be, your focus needs to be on your cash flow, okay? So your focus needs to be on monthly looking at what your flows are. So what are you going to get from your cash flow? It's going to show your liquidity. So your liquidity is going to be how much a company has available in cash to meet, as I said, the current financial obligations. On your cash flow now, it's going to be broken down into operating activities, investing activities, financing activities. So when you see it, you're going to understand it now. Operating activities. Your operating activities shows how much cash your company is generating from the core of what you're doing, from your core business operations, right? So positive cash flow from operations indicates that the company's core business is generating cash to sustain itself, right? And this is what you want. You want, when you look at those financial statements, that your operating activities is positive. It's giving you all the money that you need. Then you're going to see your investing activities. So that's going to show how much cash a company is investing in capital expenditures. So whether it's plant, property, equipment, as well as any other investments that you may have, this shows the company's growth potential and whether it's investing in the right assets to support its growth, right? So that's where you're investing. What is your company investing in? The next one now is your financing activities. So it is how much cash a company is raising to pay out its debt and equity financing. And this one is important because it's assessing a company's capital structure and whether it's relying too heavily on debt or equity financing. And we spoke to that before in terms of your debt to equity ratio, right? So you need to know all these: operating, investing, financing. So overall, your cash flow is going to be very valuable in terms of all of these are valuable in terms of assessing your financial health. This one is in terms of your cash management practices. It helps the investors and analysts understand how your company is generating and using the cash, which is a key factor in evaluating the financial performance and potential for future growth. All right. So those are the three statements that you need to understand. So I told you in terms of why it's important to understand it. I told you why it's important to update it. I told you the three statements that you need to make sure that you have, which are balance sheet, profit and loss, cash flow, and then I showed you within the balance sheet, some of the key ratios that I want you to make sure that you understand. And then from understanding it, what strategies now you can put in place because it's going good or it's not going too good. And then your profit and loss, knowing what your profitability is. And then lastly, with the cash flow and understanding your inflows versus your outflows. So what I'll do now is that if we have questions, we can take some questions in, and then I can also, go into a little detail if you guys would like in terms of showing you the actual statements. And because what is good too is that when you have your numbers, now looking at growth potential. So not just having static numbers, setting it up in a way that you can change your numbers for forecasting. So let me know, do we have questions or have they been answered in the chat? And then we could know how to steer it for the last half an hour.
All right, so we actually do have a couple of questions in the chat. So Anushka was asking, what do you mean by benchmark? How can a business know whether it is doing well compared with other businesses if you don't have access to another person's financial records, especially that of a well-performing business?
So there are industry, especially for the US, so there are industry benchmarks that you can look at, right? But if you have you can look at businesses that are on the stock market within Jamaica or within Trinidad and see all of their numbers, all of their finances, and see how they're doing. So you can look for a business closest to the type of business that you have that may be on the stock market, and their information is public, and then you take those as your key benchmarks. So as your key, so if the benchmark for inventory turnover is 5, as we showed you, and you are doing 5, you'd be like, okay, well, I'm doing well. That's what I mean by benchmark. And the best way to do it is by looking at a public company and seeing how they're doing. And I don't mean you're going to have to roll it back a bit, because you may not be at the stage of a public company, but you can use them as to where you want to be, right?
Right, perfect. And she also asked, how would you know whether the prices you pay are competitive? And I guess this is related to the answer that you just gave. How would you know whether the prices you pay are competitive or not? Or if you don't know what other businesses are paying? The same goes for profit margins.
All right, so this is prices you're paying to your suppliers, right?
Yes.
So you see, this is and I totally understand your question, because sometimes we're very secretive about business, and we like to not collaborate and to not help other people in business and to show, where the best suppliers are. But this is where now you're going to have to internally shop around with different suppliers. So just because you have a supplier and you've had them for years and you think that they're great, you are going to have to go to other suppliers and be like, what can you give me? What will be my terms? And you negotiate it. So they can either tell you yes or no, but you shop around to different suppliers and you negotiate terms that are good for you. All right.
All right. So I'm not seeing any other questions after that. Denise, did I miss any? You're on mute.
There was a question about, I think it was the debt service ratio, I believe. No, not debt service.
Or the
Equity.
ideal debt to equity ratio, yes. Let me see if I can find it again. Right. Janelle was asking, what is the ideal debt to equity ratio?
All right, so I believe I had it here. Well, usually you would want two to one, and so you would want that. No, sorry. So 1 to 1 is good. I'm sorry. 2 to 1 would mean that your debt is much higher than your equity, right? So or you would want it below. So 1 to 1 or below. Right? Sorry about that. My bad. Yeah.
All right. Do we have any other questions from anybody? You guys could feel free to either raise your hands or place them in the chat.
All right. I am going to, let me see. Yes.
While Shani brings up the slide that she's looking for, we got the question a few times, so I'll just share for everybody. The recording will be sent out, so we'll definitely be sending out the recording and the presentation, and it will also be on our YouTube channel, JMMB's YouTube channel, so you can also watch this and other workshops that we've held in the past on our YouTube page.
All right. So just so that you guys can just see in terms of how you'd want it to look. So yes, you're going to have your software and yes, it's going to be able to populate everything. But okay, you don't have your software and you're using Excel. Just this is how you'd want to set it up, okay? You would want to set it up where you have your historical results and then where you're able to forecast what you want in the future. So you're going to have live scenario. You want to see what assumptions you can have within your statements, right? So you're going to have assumptions, you're going to call it live scenario. And then you say, all right, historically, my revenue growth has been 15%, 11%, but geez, it went down to 5.9%. So you're going to be able to see what has been happening with your revenue growth. And from that, it's going to be what happened the year before versus what happened in that year, all right? And you'll be able to see, okay, you grew 15%, but now you went down to 5.9. But forecasting now, what do you want your growth to be? As I said before, you want your growth to be above inflation rate, and you want to see what's going to happen to my numbers if I have a revenue growth of 10% versus a revenue growth of 2%. So you put all of those assumptions in there. You put in some live scenarios. So some good ones here: revenue growth, your salary and benefits. What's going to happen if salaries raise? What's going to happen to my numbers? What's going to happen with my accounts receivable? If I give them extended payment terms, what is going to happen? When is the money going to come in? Am I now going to not be making enough money to be repaying my debt, right? So you want to make sure that you're utilizing your accounts so that you can see potential for growth and potential for what is going to happen in the next 5 years. Set it up to have forecasts for the next 5 years, okay? Because that's what you want to see. So as I said, with income statement, you lay out your income statement in terms of what your revenue is, minus your cost of goods sold, and that's where you're going to get your gross profit, right? So your gross profit is when I was telling you with those calculations and those formulas and ratios, right? So you're going to see your gross profit, And then what are your expenses? Under your expenses, you're going to put all the expenses that you have. Salary, rent, depreciation, your interest. And then you're going to see what your total expenses are. And you're going to see what your earnings are before tax. This is where, as I said, your taxes are going to go. You're going to see how much you're paying in taxes. So what is going to happen year over year? What has been happening? And then you'll see what your net earnings are, okay? So your income statement, as I said, it's going to show you your profitability, how profitable you are. Your balance sheet now is going to show you your assets versus your liabilities and your shareholders' equity. So your assets, your most liquid assets go on the top. So your cash, your accounts receivable, your inventory, and then you have your plants and property, and that would be your total assets. So all assets you have, they're going to be listed here. Now your liabilities, same way it's going to go in terms of your most liquid, right? So your accounts payable, that's if you had to get those in, if you had to pay those out, that's the easiest to pay, right? So your accounts payable, your debt, that's your total liabilities. And then what's your equity? What is the shareholders' equity? And it's going to be broken down into your equity capital and your retained earnings. All right. Then you have your cash flow. Your cash flow, as I said, it's broken down: investing, financing, and I forgot operations first. Operations, investing, and then financing, right? So you're going to see what your net earnings are, what your investment in property and equipment is, and then for financing, you're going to see what your debt versus your equity is. When this is set up right, with the right formulas behind it, everything kind of flows into each other. So where your cash changes, right? So your closing cash here at the 67, right? It's going to now populate into your balance sheet as the cash that you had, right? So I think what you need to do is sometimes just sit with your statement and you understand for yourself where it relates to what, and if this goes here, oh, this goes here, but then it means that it goes up here too, because every statement flows into each other to give you a whole picture of what it's supposed to look like, right? So this is something too that we can send out to you as a working document also, that you can play around with. You can put in your numbers and then you can do your forecasting. You can see, okay, are all the checks right? Because it's going to tell you up here, it's going to have your balance sheet check. That's going to be okay. It's going to have your checks right here. If it's off, you know, so playing around with your numbers, understanding your numbers, it's going to give you so much insight into your company that you're going to be like, this is awesome. I didn't realize that I could understand this so much and that I could think out my business this much, okay? So we will definitely put this together for you so that you could now sit and say, I got this. You know, you still need an accountant. I'm not telling you don't have an accountant, but you need to understand for yourself. All right. So any other questions? Anything else?
No more questions. All right, so we are actually at the end, exactly at 8 o'clock. Shani timed us perfect. And I can confidently say that we delivered on our promise when we started, that you're gonna have an informative session. So thank you so much, Shani. If you have any questions, please let us know. Send us an email, SMEresourcecenter@jmmb.com. We'll be happy to assist you. As I said, our workshops are on our YouTube page. We have a lot of very important business topics that we have done in the past. So feel free to visit our page and watch those sessions if you did not get a chance to do so. So thank you everyone for coming out. We look forward to seeing you next month at our next workshop.
Thank you.